Hello, Accounting Superstars. This is Professor Don Bush from the Accounting Superstar channel. I've been a professor for about 30 years and a CPA for about that long, and I've got great ways to explain accounting. So welcome aboard. Hey, another fantastic day in Colorado. It's starting to cloud up a little bit, which is expected. It's June 29th here, and beautiful day though. Beautiful day. Can't wait to get outside. So today's lesson is we're trying to figure out if we should eliminate a department. All right, it's a huge decision, folks, one that can't be taken lightly here. A lot of you guys and gals are not going to major in accounting, but are going to be managers. And so this decision will be on your shoulders, and it's huge because once you eliminate a department, it's really, really hard to bring it back again, if not impossible. And also, a lot of people's lives are involved here. You know, you've got workers that might be laid off, managers that are laid off, customers that are disappointed, and so on and so forth. So, huge decision here, guys. So, I'm going to help you guide you through such a decision. And once you understand it, it's pretty easy to understand to figure out what the best thing to do is. But here we go. So, we've got Sunset Sailboat Company. They build beautiful boats, and they've got a 22-foot boat that they call the Kingfish. And here's a picture of it right here. And management just received this giant report here. And management's not real happy at all. They've got a 15-foot swordfish, which seems to be doing really well. The income on that one's good. But this 22-foot Kingfish doesn't look so hot. In fact, here's a picture of the boss down here getting really angry. It looks like it's losing money, and that's where the worries are. But it looks like the 25-foot Sunfish is doing well, and the 32-foot Angelfish is doing well. And overall, the company's got a nice, healthy profit. But the management is wondering what is going on here. Should we get rid of the Kingfish? Because if they did get rid of the Kingfish, their profit might increase by quite a bit, by $128,750, and that's what they're thinking. So it's a big decision, though. Really, really big decision. And by looking at this statement here, it's really hard to tell. In fact, it's pretty much impossible to tell what the right thing to do is. And a manager who just said, okay, we're getting rid of the Kingfish based on what you see right there would be very, very foolish, all right? It's good to dissect this and look into it and find out what's really going on. Fortunately, it's not too hard to do. So here is some information that will help out. Okay, so here's some information. So letter A here, the revenue is tracked carefully and is accurate. So in other words, these revenue numbers, 900,000, 850,000, so on and so forth, they know that that 850,000, that came from Kingfish sales. They know that for sure. So that is done. It might sound kind of silly, but a lot of businesses don't know even basic stuff like that. Letter B, cost of goods sold. Now, 90% are direct costs. So let's go up here to cost of goods sold. So cost of goods sold, here it is. So cost of goods sold, out of the 700,000, 90% of it is known for sure to belong to the Kingfish. They're called direct costs, like direct labor and direct materials. These are direct labor. Those are people that worked on the boat. They built the boats, and they kept good track of their time. And direct materials, these are materials that went into the boat, like fiberglass and boat motors and boat rudders, boat anchors, teak wood, whatever. So 90% of that 700,000, they know for sure went into the Kingfish. And this is true for the other boats too, that 90% of the 520,000 went into the Swordfish, and so on and so forth. The other 10%, they're not really sure. The other 10% is manufacturing overhead. And a lot of that manufacturing overhead is things like property taxes or insurance or overhead lighting. And a lot of these costs are going to remain the same, whether the Kingfish stays or goes. You know, they'll still have these costs. They'll still have to pay property taxes. So in other words, in a nutshell, 90% they know for sure belongs to the Kingfish. The other 10%, not sure at all. Let's see what else they're saying. So administrative expenses. So letter C, $100,000 of administrative salaries are directly associated with each department. and would be eliminated if the department was eliminated. And it's called production manager salary. So going back up to this statement here, production manager salary, well, it's included right here in the administrative salaries, right there. I'll highlight it right here. So in each boat category, they have a dedicated manager, and that dedicated manager is paid $100,000. All right. So out of the $150,000 for the swordfish, $100,000 goes to this product manager. Out of this $150,000, $100,000 goes to the kingfish product manager, so on and so forth. Now, unfortunately, if the kingfish product line, if the kingfish sailboat is eliminated, well, this manager's job will be eliminated too. So it will go away. The other $50,000, not too sure. It may go away, may not, but the other $50,000 cannot be related directly to the kingfish. Only the $100,000, the product manager's salary. Let's see what else we have here. Letter C3. All other administrative expenses are allocated and fixed and will continue even if the department is eliminated. So in other words, all these other costs like office rent expense, they're sticking around. Doesn't matter if the kingfish comes or goes. That $50,000 will not go away. In fact, that $200,000 will remain exactly the same. Office utilities expense, same deal. That $160,000 is not going to go away. It's only these administrative salaries where $100,000 will go away for the kingfish. Office expense at $85,000, not going to go away. Office depreciation expense, $70,000, not going away. They could get rid of the kingfish line and they'll still have that $70,000 expense. So let's figure this out. Let's see how it works. So what we're going to do is we're going to figure out this contribution margin by product line. Now I've got all the numbers filled in for the other departments just to save us time, but we'll figure out the kingfish here. And whatever we do with the kingfish, you could do the same thing with the swordfish and the sunfish and angelfish, and it'll all work out. And what's going to go in this top section here, in this first group of numbers, are revenue and costs that are directly associated with the kingfish. Directly associated, like direct labor and direct materials. And down below here, these are costs that are not directly related to a department. These are costs that are allocated or are fixed. They're not going to go away if the department's going to go away. And we call this a contribution margin statement because right here, the contribution margin, and I like to do the contribution margin percentage. The contribution margin, that is where the decision is made. So in other words, swordfish, doing great, looking good. It's offering $332,000 worth of contribution margin. Sunfish, fabulous. Man, that's a big contribution margin. And the angelfish, even better. Man, it would be foolish to get rid of those boats. Very foolish. So let's see how the kingfish is doing. So I need to split the screen so we can see where these numbers come from. So all we're going to do is get the revenue right here from the kingfish. We're going to take that $850,000 and drop it into place. That's all we're doing. There we go. Oh, didn't stick around, did it? Here, let me try that again. There we are. Okay. Now the assigned cost of goods sold. Now cost of goods sold is $700,000, but we learned from reading the material that 90% of it is directly related to the kingfish, directly related. And if we got rid of the kingfish, we get rid of 90% of these costs. So 90% of 700,000 is 630,000. Now, guys and gals, every company is going to be different. Don't think every company in the world, 90% of cost of goods sold is directly related. That's not true at all. I'm just trying to make the example as easy as I can, all right? So some companies, it might be 40%. Other companies, it might be 20%. Who knows? So you have to know your company that you're working with. Now, assigned production manager salaries, that comes from right here, the administrative salaries. And from the information, out of this $150,000, 100,000 is directly related to the Kingfish, the production manager's salaries. So 100,000. The other 50,000, we're not sure. All right, so now we can figure out this contribution margin. So let me get this. Here we go. Contribution margin. To figure out the contribution margin, and this is the key number, folks. If it's positive, that's good. Negative, not good. All right, so all we're going to do is take our 850,000, minus away the assigned cost of goods sold, minus away the assigned production manager salary, and let's see what we get. 120,000. Now it's positive. That's good. That's good. That means that the Kingfish is contributing towards covering those fixed costs and those and to a profit. Let's see what the contribution margin percent is. And to figure out the percent, all you do is take the contribution margin, divide it by the revenue, and we get a percentage. And it comes out to 14%. Now, that's not good compared to the other lines here, 37% for the swordfish, 43% for the sunfish, 47% for the angelfish. So this is really weak, but at the same time, it is contributing. It's not contributing as much as maybe it should, but it's still contributing. All right, so coming down here to the other costs, the cost of goods sold not assigned, all I'm going to do is, it's really easy here, come up here to cost of goods sold, and I'm going to take 10% of that, all right? That's the other 10%, because we took 90% for the direct costs. And then all we do is we take our expenses here, office rent expense, there it is, came from right there. Office utilities expense comes from right there. Administrative salaries not assigned. Now, 100 grand from each category, from each boat was assigned. That leaves us with 200,000. And the same thing with the other expenses, the office rent. And okay, so the office rent, depreciation, there we go. Bring those down. And then what we do is we total this up, get a grand total of these expenses that are not assigned. They come up to 989,000. Our net income is 745,000. Now the way you check your work is, here's our top statement. Look at that, 745, 745. So the numbers are identical. We just rearranged things a little bit. We moved the furniture around. So what would happen if they got rid of the Kingfish? Well, the current net income is 745. And if they got rid of the Kingfish, what would happen is they would lose out on that contribution margin. There's that contribution margin right there. They would lose out on that. And so what would happen is if they got rid of the Kingfish, they'd be worse off. Wouldn't that be horrible to think that, oh, you're fixing the problem, but you made things worse? So managers, you guys and gals that are going to be managers, you don't want to do this. So let's just take a look at this contribution margin income statement in its entirety. This is what it looks like. So in the upper section, you put costs that are directly related to each product line. And down below, you put costs that you can't, that are allocated or fixed costs, or you can't associate with the product lines. And the net income should be the same as the net income on the other statement too. That way you know if you did a good job or not. And the way you make a decision, if the contribution margin is positive, good. Contribution margin negative, bad. Okay, so there you go. Hope this helped you out. And folks, hit the like button and subscribe button. And we'll see you next time. Over and out.